In our last chapter, we discussed information about the U.S. Small Business Administration, and we're going to continue that discussion in this chapter. My name is Jane Rich, and I am a business advisor with the Northeast Indiana Small Business Development Center. In this session, we'll continue discussing and understanding the role of the U.S. Small Business Administration in providing credit to businesses. We're going to discuss the second of two primary programs administered by the SBA and discover how this program may impact your funding needs. The second loan program under the Small Business Administration is the 504 loan program. Under this program, it is a two-tiered loan program. What this means is you get a first loan provided by a bank, and then a second loan that is provided by a certified development company, or CDC. These loans are for supporting the purchase of fixed assets or capital assets for a business, meaning real estate or equipment. There must be an economic impact as a result of providing the financing, and this is defined by job creation or meeting another federally defined economic objective. The government wants to see one job created for so many dollars that it lends underneath this program. Here's an example of how the 504 program works. Let's say you're constructing a new building at a cost of $1 million. The bank will commit a first mortgage loan for up to 50% of the project. In this example, $500,000. The CDC will commit or provide a second mortgage loan for up to 40% of the project amount, or $400,000. The borrower has to come up with a minimum 10% equity injection into the project, or $100,000. This is a true benefit because traditional financing of commercial real estate usually does not allow a borrower to finance up to 90% of eligible project costs. The 504 program does enable a business to finance 90% of the purchase of equipment or real estate. By combining the two loans, the borrower ends up with a blended maturity and blended interest rate, which are typically more attractive and more favorable to the borrower than conventional financing. The borrower receives bond financing for a portion of the project. The CDC funding for up to 40% is actually a bond that is sold, which provides long-term, fixed-rate, below-market financing. The 504 program is only for owner-occupied real estate, and borrowers cannot use proceeds to purchase investment properties. Additionally, the minimum project size is $125,000. And remember, for owner-occupied real estate, that means the business must occupy 51% of an existing building they're acquiring, or 2/3 of new construction. If they're going to lease out the remaining space, they can't rely on that rental income as an identified payment source for the loan. Repayment has to come from the business's existing cash flow. Again, debt on real estate, like anything else, can be repaid from the ongoing cash flow, selling equipment or other assets, or refinancing debt with other debt in the future. Other SBA loan programs that are available are typically variations of the two programs we have discussed. The ARC loan program is a program for existing businesses that enables them to borrow up to $35,000 to repay other existing debt. This program was available in 2009 and 2010, and you should check with the SBA on availability today. The Veterans Program and the SBA Express Loan Program are variations of the 7A program, allowing veterans, minorities, and very small loan requests to have streamlined loan applications, modified eligibility requirements, and some modified underwriting terms. If you need additional information on any of the SBA's programs, please visit their website at www.sba.gov. If you have any additional questions about getting ready to apply for a loan, please feel free to contact me. Again, it's Jane Rich, Business Advisor with the Northeast Indiana Small Business Development Center, and our office number is 260-481-0500, and my email address is jrich@isbdc.org.